Welcome to Tech Money Madness, your daily U.S. stock market podcast, July 28, 2026.
And what a wildly confusing day to be looking at the markets.
Oh, absolutely. I mean, imagine you're driving a car down the highway, right? And your speedometer right in front of you clearly says you are slowing down.
Right, you're easing off the gas.
Exactly. But you look at the dashboard and the temperature gauge is just completely buried in the red.
Oh, yeah.
Like actual smoke is starting to pour out from under the hood.
That is the perfect analogy for today.
Right. That contradiction, that mechanical disconnect, is exactly what the United States economy is doing this morning.
It really is.
So if you're looking at your portfolio today and wondering why the major indices just look like a sea of red mixed with these, violent flashes of green, you aren't alone. We are seeing incredibly broad volatility.
Yeah, it's everywhere.
But we aren't here to just read you index points on this deep dive. You're listening to figure out the actual mechanisms driving this tape.
And to understand the sheer structural tension on the trading floor today, you really have to look at the market as this massive, high-stakes tug-of-war.
Okay, I like that. Who's on the rope?
Well, on one end, we have a very real global economic slowdown. I mean, it is palpable and it is pulling hard.
Definitely.
But on the exact opposite end, pulling with an equal and just massive force is the most cash-heavy infrastructure build-out in modern history.
The AI investment race.
Exactly. The AI race. These two macroeconomic forces are fundamentally at odds with each other.
So the volatility you're seeing in your portfolio today is simply the tension in the middle of that rope.
Hit the nail on the head. That's exactly it.
So let's get into the data dump we got on the U.S. economy. Because my first instinct when looking at this is to assume the Federal Reserve is, getting ready to take a victory lap.
Yeah, on the surface, maybe.
Right, because we got the June Consumer Price Index, the CPI, and it rose 3.5% annually.
Which is actually less than expected.
Yeah, exactly. And we also saw wholesale prices drop 0.3% in June. So if you just read those headlines, you'd think inflation is finally backing off.
You would. But when we look under the hood, I'm guessing they absolutely cannot take that victory lap.
They really can't. Because then we get the Fed's preferred gauge, right? Core inflation.
Oh, man. Yeah, the core inflation number.
It hit 3.4% in May. That is the highest we've seen since October of 2023.
Wow.
So help us reconcile this. How on earth can headline inflation fall while core inflation is literally climbing to multi-year highs?
Well, the headline CPI number is basically acting as a massive smokescreen right now. And the wind blowing that smoke is the energy market.
Okay, walk us through that.
So the standard CPI includes highly volatile commodities, right? Things like food and gasoline.
Right, the stuff we buy every day.
Exactly. And because gasoline prices took a pretty steep dive in June, the overall headline number was dragged down with it.
Ah, I see. So it artificially makes the economy look like it's cooling.
Precisely. But core inflation deliberately strips out food and energy. It's trying to reveal the underlying structural cost of living.
So we're talking about things like housing, medical care.
Yeah, and just the baseline cost of running a services business.
So basically the drop at the gas pump is completely masking the fact that your rent and your services are still getting way more expensive.
That is exactly what's happening. Core inflation is sticky. It has deeply embedded itself into the services sector.
And that brings us to the labor market data, right? Because when you combine that sticky core inflation with the labor numbers we just got, the mechanics of a soft landing become, well, incredibly difficult to execute.
Oh, near impossible. The labor data from June is the piece of the puzzle that is really flashing red today.
Yeah, we saw job creation severely cool off. Payroll growth was just 57,000 jobs.
Which is very light.
Super light. And the unemployment rate ticked up to 4.2%.
But that's not even the scariest part.
No, it's not. The metric that is setting off alarm bells everywhere is the labor force participation rate.
Right.
If you exclude the anomaly of the COVID-era lockdowns, labor participation just plummeted to its lowest level in 50 years.
We really need to unpack the implications of that 50-year low because it changes the entire inflation equation for the Fed.
How so?
Well, the standard unemployment rate of 4.2%, it only counts people who do not have a job and are actively submitting resumes to find one.
Right. They have to be actively looking.
Exactly. But the labor force participation rate measures the total pool of available workers in the country.
Okay.
When that number drops to a half-century low, it means millions of people are simply walking away from the workforce entirely.
Like they're retiring early or just opting out?
Retiring early, opting out, or they're just permanently discouraged.
And a shrinking pool of available workers means that businesses have to fight way harder for the ones who are actually left.
Exactly the mechanism at play. If you run, say, a logistics company or a hospital, and your pool of available workers is shrinking, what do you have to do?
You have to offer higher wages to attract talent.
Right. And those higher wages force you to raise the prices of your services to cover your costs.
Wow. So even though top-line job creation was a really weak 57,000, a shrinking labor pool keeps wage pressure incredibly high.
Yep. Which in turn feeds directly into that sticky core inflation we just talked about.
It honestly borders on a stagflationary environment,
Hmm.
like stagnant overall growth, but structurally high costs.
It really does. Which completely explains why the chatter in central banking circles is suddenly getting so intense this week.
Yeah, let's talk about that. If you follow Fed policy, you probably know the name Kevin Warsh.
Oh, absolutely. Highly influential former Fed governor.
Right, and his recent public rhetoric is really raising some eyebrows.
It's been aggressive.
Very. He called the current economic situation a family fight. He talked about returning to first principles,
Mhm.
and most notably, he stated on the record that inflation is a choice.
That quote is wild. When a central banking heavyweight uses a phrase like inflation is a choice, he is firing a direct warning shot at the current Federal Reserve leadership.
What's the subtext there?
He's implying that the Fed actually possesses the tools to crush this sticky core inflation tomorrow, but they are actively choosing not to use them out of fear.
Fear of breaking the economy.
Exactly. And when he says returning to first principles, that is essentially code for abandoning the delicate tightrope walk they've been doing for the last decade.
So prioritizing sound money and price stability above all else.
Above all else, even if it requires deeply unpopular hawkish policies.
And in this context, hawkish means keeping interest rates aggressively high, right? Even if it intentionally slows down the economy and breaks the labor market.
Right. Fed watchers are interpreting Warsh's comments as a glaring signal that patience is wearing thin behind closed doors and tighter policy adjustments might be brewing.
Well, if Warsh thinks the Fed is just choosing not to act, he's probably looking at how this U.S. hesitation is colliding with a massive domino effect happening overseas.
Because inflation is definitely not staying inside U.S. borders.
Not at all. We absolutely cannot analyze the U.S. economy in a vacuum. The shockwaves are completely global.
So let's look at how this is playing out internationally.
Yeah, over in Singapore, the central bank just made a total surprise move to tighten their monetary policy,
Yeah.
essentially raising their version of interest rates.
And what was their stated reason?
Rising global oil prices.
Yeah.
It's rekindling their domestic inflation risks.
Interesting.
Then you jump over to India, and their inflation just accelerated to a higher than forecast 4.38% in June.
And let me guess, driven heavily by energy and food.
Exactly, those same global energy and food costs. But the most vital piece of international data we got today definitely comes from China.
China is the big one.
Right. China just posted its slowest quarterly growth since 2022. Domestic investment is slumping, and their consumer price growth severely weakened in June.
Very weak consumer demand over there.
Right. Yet despite that, their producer inflation rose to near a 4-year high.
Yep.
So I really want to pause here because this feels like a paradox.
It definitely does on paper.
If China's domestic growth is slumping so badly and Chinese citizens aren't spending money, why on earth did U.S. import costs from China just post a surprise gain, hitting their highest level since 2008?
That is the defining question of global trade right now. And it really comes down to separating the Chinese consumer from the Chinese factory.
Okay, break that down for us.
Domestically, the Chinese consumer is hurting badly. They are dealing with a massive real estate crisis. Their consumer confidence is entirely broken.
Oh, domestic retail prices are weak because no one is buying.
Exactly. But the factory owners producing goods in Shenzhen or Guangzhou, they are dealing with a completely different reality.
Because of their input costs.
Yes. Their input costs, the raw materials, the global energy required to run the machines, the logistical friction of international shipping, all of that is skyrocketing.
So even if that factory owner desperately wants to lower the price of their goods to, stimulate sales, they mathematically cannot.
Right, because the copper, the oil, and the shipping containers just cost too much.
So they're basically trapped.
They are completely trapped by their input costs. They have to pass those elevated manufacturing expenses onto someone in order to survive.
And since their domestic consumer is completely tapped out, they pass those costs on to their export markets.
They pass them on to the United States.
Wow.
That is exactly how China exports its energy-driven producer inflation directly to American shores, which perfectly explains why U.S. import prices are hitting those 2008 highs.
It just perfectly illustrates how global energy volatility ties all these sovereign economies together.
It really does. Singapore tightens because of oil, India spikes because of energy, and China's raw material costs complicate the Fed's job in Washington.
So we have this really heavy, somewhat grim macroeconomic picture, right? A shrinking labor pool, imported inflation from China, central bankers debating how hard to hit the brakes.
It's a lot of pressure.
It is. But let's pivot to the micro level,
Yeah.
specifically to the tech sector. Because while the global macroeconomy feels like it's sinking in the mud, big tech is operating on a completely different planet.
Oh, they are playing a completely different game right now.
So let's dive into the specific stock moves. First, Alphabet, ticker GOGL.
Right.
They just delivered excellent Q2 2026 earnings, but the stock actually saw a pullback.
Which is interesting.
Yeah, Wall Street seems to be viewing this dip as a solid entry point.
I agree with that sentiment.
Then we have Apple, ticker AAPL. Their fiscal Q3 earnings are looming on July 30th, and expectations are massive.
Huge expectations. Analysts are looking for what, 16% revenue growth?
16% revenue growth and 20% earnings growth.
Wow.
But then we have the cautionary tale of the day. SanDisk, ticker SNDK. Their stock absolutely cratered this morning.
It fell off a cliff.
The reason? Mounting Chinese competition in the NAND memory market is severely threatening their historically high profit margins.
So the contrast between these three companies highlights the two very different strategies dominating tech right now.
How do you mean?
Well, Alphabet, along with Amazon, Microsoft, and Meta, they are locked in an existential capital spending race for AI infrastructure.
Right, the CapEx race.
Exactly. When we say capital spending, or CapEx, we are talking about the physical, hard assets required to run artificial intelligence. Alphabet isn't just writing software anymore.
No, they're pouring tens of billions of dollars into buying actual land, building massive data centers, acquiring GPUs, securing power grids.
Right. To use an analogy, Google and Microsoft are spending billions to lay down the electrical grid, pour the concrete, and build the infrastructure for a massive new AI city.
Just hoping that eventually consumers will pay to move there.
Exactly. Apple, on the other hand, seems perfectly content to just wait and sell the smart appliances that plug into that grid once it's already built.
That is a fascinating way to visualize it.
Apple is showing very minimal direct capital spending on AI infrastructure compared to their peers. They just aren't bleeding billions to build the server farms.
Instead, they are integrating AI into their existing consumer devices in a highly disciplined way.
Right. And by avoiding that massive infrastructure capex, Apple is protecting its free cash flow.
The actual cash a company has left over after paying for its operations and investments.
Yep. Their strategy is yielding record-breaking cash reserves.
So my instinct is to say Apple is safe because it's this premium, untouchable brand. But I have to push back on whether their incredibly high valuation is actually justified in this macro environment we just talked about.
That's the billion-dollar question.
Because Apple's growth is heavily cyclical, right? It relies on consumers feeling wealthy enough to upgrade their iPhones and iPads every few years.
Exactly.
But if we just establish that the global consumer in both the US and China is feeling a massive economic pinch, those upgrade cycles are going to stretch out.
They have to.
And look at what happened to SanDisk today. SanDisk makes NAND memory, the physical flash storage chips inside your devices.
Right.
That used to be a highly specialized, high-margin business, but it became commoditized. Everyone figured out how to make it. Chinese competitors flooded the market, and SanDisk's pricing power just evaporated overnight.
It's a brutal market.
So if a giant hardware component maker can have its margins crushed that quickly, isn't it dangerous to assume Apple's high-margin hardware dominance is universally invincible?
It is incredibly dangerous.
Like, if a cheaper Chinese smartphone can run the exact same cloud-based AI tools, does the expensive iPhone upgrade cycle eventually stall out?
That is a phenomenal connection, and it totally validates the anxiety some institutional analysts are whispering about regarding Apple's current valuation multiples.
Right, the premium investors are paying for every dollar Apple earns.
Exactly. Right now, investors are paying a massive premium for Apple, just assuming their profit margins are permanently etched in stone.
And SanDisk proves they aren't.
SanDisk is the canary in the coal mine for hardware. It proves that physical tech margins are perpetually under attack.
Now, obviously, Apple possesses a robust software ecosystem and brand loyalty that SanDisk never had.
Of course. But ultimately, Apple's core revenue still relies on moving expensive physical units. If the global consumer slowdown deepens and competitors offer good enough AI features on devices that cost half the price, valuing Apple as a flawless, infinite growth sanctuary becomes a major risk.
It is vital to question the assumption of tech invincibility when their revenue is tied to discretionary consumer spending.
Absolutely. Which perfectly explains the capital migration we are seeing on the ticker tape today.
Yeah, let's look at the daily market movers. Because it's not the individual top gators and losers that matter, it's the broader sector trends.
The tape is definitely telling a story about where the smart money is seeking shelter.
The investment flows right now seem violently bifurcated.
Very much so. On one hand, you have capital continuing to flood into AI and tech.
Despite the high valuations and the hardware risks we just discussed.
Exactly. The sheer gravity of the AI productivity narrative is just overpowering the macro fears. Investors are terrified of missing out on the next technological revolution, so they keep buying the dip on the infrastructure builders.
But on the completely opposite end of the spectrum, we are seeing massive defensive flows into the energy sector.
Because energy is the ultimate macroeconomic wildcard right now.
Right.
It is a highly volatile sector, but as we discussed with Singapore, India, and China, the price of a barrel of oil is practically dictating global inflation trends right now.
So capital is rotating into energy not necessarily because investors expect massive innovation, but as a strategic hedge against sticky inflation and geopolitical instability.
That's exactly why they're doing it.
So, if you are listening to all this and trying to figure out where to put your money tomorrow, how do we synthesize these completely disparate puzzle pieces for your portfolio?
It's a lot to take in.
It really is. We've gone from a shrinking U.S. labor pool to Chinese factories exporting inflation to the data centers of Google and the iPhone cycles of Apple.
Yeah.
How do we boil this down?
Well, it comes down to understanding the 5 key pillars driving the market right now.
Okay, let's hear them.
Pillar 1 is the global economic slowdown. It is real, and it is evident in China's slumping domestic investment, India's rising costs, and the structural shrinking of the U.S. labor force.
Got it. And slamming right into that slowdown is Pillar 2, the AI investment race. Tech behemoths are ignoring the macro weakness and spending tens of billions on infrastructure, fundamentally altering their balance sheets to build this new tech city.
Exactly. Which brings us to Pillar 3, monetary policy adjustments.
The Fed.
Right. Because of the sticky core inflation driven by labor shortages and global energy costs, central banks are on high alert. The era of easy money is being challenged by figures like Kevin Warsh, and policy shifts are imminent.
All of which guarantees Pillar 4, continued market volatility.
Oh, absolutely. Until the market knows definitively whether we are getting a hard recession or a soft landing, every single data point, every jobs report, every CPI print is going to cause outsized, choppy swings in the indices.
And finally, Pillar 5 is sector rotation.
Right. Capital isn't necessarily leaving the stock market, it is just seeking the right shelter. We will continue to see money oscillate violently between the defensive inflation hedging posture of energy and the perceived long-term growth sanctuary of big tech.
It is a complex battlefield, but understanding those mechanics gives you a massive edge over the investor who is just, reacting to red and green arrows on a screen.
It really does. And before we wrap up today, I want to leave you with one final, unscripted concept to ponder.
Yeah.
Something that builds on everything we've just discussed, but isn't really being priced into the market yet.
Oh, I like the sound of this. What is it?
We've established that tech behemoths are pouring unprecedented billions into building massive AI infrastructure. They're building the future on the assumption that demand will be infinite.
Right.
But we also just established that the broader global consumer, the actual people and businesses in the US and China who are supposed to eventually pay monthly subscriptions to use these new AI tools, is slowing down. Their wallets are tightening.
Right. The macro slowdown.
So what happens if the timeline for AI profitability takes much, much longer than Wall Street's current patience allows?
Wow.
We are pricing in immediate, world-changing financial returns on these AI investments. But if the global consumer simply isn't strong enough to adopt and pay for these tools at scale over the next 24 months, those massive capital expenditures are going to look like terrible, bloated investments in the short term.
That's a scary thought for tech investors.
If that realization hits the street, could the ultimate sector rotation not be a move from one tech stock to another, but a massive, painful flight out of the tech sector entirely?
Oh, man.
It is a timeline mismatch between infrastructure cost and consumer capability, and it is a risk every investor needs to keep in the back of their mind.
That is exactly the kind of critical underlying question that makes navigating these markets so fascinating. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.